I'd like to share my screen with you so we can see the underwriting on this deal. Fritz, I'm going to go ahead and push this over to you. Can you see that on my screen?
You bet.
Okay, perfect. So here's what we did. We've got the 10-year and the 12-year here. You can see our loan dollars that we got, and we're sizing it depending on which of the opportunities you want to look at, whether this is step down prepayment or it is the yield maintenance. These are the LTVs. This area is max at 80% with a debt service of 1.25, which is they raised in COVID from 1.2 to 1.25. And then we've got the interest rate here. We've got to make sure that we cover the underwriting floor rate, which you guys don't really need to understand, but we've got to make sure that it's kind of like a stress test. And if we can go for interest only, we have to get a little bit more understanding of the deal and figure out what we can offer. There is an increase when we go to interest only, and that's usually 4 bips per year. And then this is the amortization. So this is how it looks every time you get something from Colliers. Up here at the top, it has your price, your purchase price, price per unit, the units, where it's located in the name. So just so we're getting familiar with how to look at these. So this is where I'm going to push over to Fritz so he can show us exactly the information of how he is underwriting these deals. Does anybody have any questions so far on looking at how we provide the sizing for you? Nope. Okay, great. So Fritz, if you would take it here on the underwriting.
Sure. So Julie has up, you can see the cash flows. And so how Fannie underwrites these deals is, even though, on acquisition, they're really only going to underwrite in-place income. So there's really nothing, it's generally just trailing 3 months of income from the net rental side all the way through other income. So there's really not a lot you can do to change, to underwrite to a certain effective gross income or total income. And so that's pretty straightforward. So, it depends on how the property is going to perform all the way through closing. So we'll just underwrite to in-place income. Where there's a little bit more, variability is when you move down to the expenses. On an acquisition, you can take a look. We'll really look at a mixture between historicals, your budget, and how you think you can operate the property, and then ultimately, you'll get an appraisal that will support what our market expenses. So, for example, if you have an operator who is running things pretty fat and high payroll, maybe high management fee, we don't necessarily have to underwrite that. We can take a look at how you think you can operate the property, and really the check for us is making sure that the appraisal supports the expenses. So, like, for example, if you're looking at our underwriting here, if you don't go down to expenses, you take a look at the payroll item, you can see historically that the seller was only operating the property at about $43,000 for total payroll. Now, I would say when we spoke to an appraiser, that's probably pretty light, and so we couldn't support underwriting, that low of payroll in our cash flow analysis. And so that's why we underwrote to, $1,000 a door, or just $106,000. So that's kind of an example of how we have to look at things. Now, for example, if hypothetically the payroll historically was $143,000, that would be too high, based on an appraiser's how they would look at, market expenses. So we would be able to underwrite less expenses. So it's not really a perfect science. It just depends on the market, it depends on location. The other really big variable, and this is, really market driven and even county driven, is your real estate taxes. So we have to take a look at how the taxes are going to be impacted post sale. So there's some counties, like for example in Minnesota, where it's pretty straightforward. You're going to take the purchase price, times it by 90% and hit it at the millage rate, and that's where taxes are going to be reassessed. Very straightforward and across the board. If you go to a market like Texas, or it's a non-disclosure state, it's not exactly a perfect science. So we'll lean in to see how the appraiser thinks, the taxes will be reassessed on a sale. And that can be 50%, that can be 60%, that can be all the way up to 95% of value. So it really depends on the county. So you need to make sure that on our end, what we do with Julie and the rest of the Old Capital team is making sure that even before we send out a loan quote, we'll have a conversation with an appraiser so we feel comfortable with where we're underwriting taxes. The other, variability, what I will tell you when you look at our cash flow analysis is the replacement reserve, which is the last expense item where in this example, we assumed 300 per unit per year, or little over 31,000. That's a set aside reserve that's held with us for you to use for capital needs throughout the project. And that ultimately, that number is determined by, we'll order a property condition assessment as part of the due diligence process. And that report will spit out what that independent engineer thinks the capital needs for the project are going forward. And that's how we ultimately get to our net cash flow, or NOI, which ultimately determines how much debt the property can support. So as Julie talked about when she was going through the kind of the quote matrix, this deal is currently debt service constrained at a 1.25. So you need to make sure that our NOI is 1.25 times what the debt service payment are. And so in this example, we're coverage constrained at 1.25 times, but technically you could go up to 80% loan to value so long as you're above a 1.25. Any questions kind of on the general overview? Julie, I don't know if you have any other thoughts.
That was excellent. Thank you so much, Fritz. I don't have any questions. That was very thorough.
Yeah, no, I agree. Any questions on, if I look at this from a beginner standpoint, is a lot of people ask me, okay, on this test, this underwriting, how come I'm at 1.415 on that last column when I see 1.427? Because this is a very common question that we get. And I do want to point out that it's because we're underwriting to 5%. As opposed to, what we see here is 3%. So we're always going to make sure that we have the 5%. However, if it comes in where it's 7.2, we're going to use that number. We're going to use the real number. But if it's less than that, we'll be using 5%. So that's why this number 1.415 is different than, like we talked about, 1.427. So I'm sure that makes a lot of sense. Any other questions on this?
Right. And when you're talking about the losses, do you focus primarily on the physical vacancy or economic vacancy?
Yeah, that's a great question. The minimum for Fannie is a 5% total vacancy, but hypothetically, if this property is well occupied and doesn't have a lot of bad debt. But yes, if say there was a 10% economic vacancy, we'll take a blend of whatever the property's currently reporting. So if it's 6% physical and 1% concession and 2% bad debt, we'll incorporate that to get to our net rental income number.
Anything else?
Excellent.
I mean, yeah, you did a great job there, Fritz. Really makes a lot of sense. I think where we see a lot of issues is exactly what Fritz said. On the payroll is always a challenge. We just had this situation earlier where we underwrote at 600. Our clients did, and we had to bring it up just like this at $1,000, and it really killed the deal, unfortunately. So you do need to figure out those that are pretty standard and use them in the underwriting model that you're using.
Right. So for example, the property we closed on with you, Julie, in December, we underwrote $1,000 in payroll, and in that specific area, the past 2 months, it's been operating at $370 a month in payroll, which is excellent.
Yeah.
With that information, if we find a similar size and class asset that's going to be managed by the same management company in the same area, would you take that into consideration moving forward on a future similar deal?
I would say from a lender's perspective, I think you could try to take into account, but ultimately, if you're able to operate the property well below market, that's great. But how the lender has to look at it is, unfortunately, from a pessimistic point of view, is if for some reason something happened to the property and you default on your loan and we have to operate it, if we have to hire a third-party property management company to operate the property, what are the actual market expenses? And so that's why if an appraiser comes out and says, no, yeah, $300 a unit is market, and they're doing a great job managing expenses, and that's supported in the appraisal, we can underwrite to it. But if the appraiser comes back and says, at market expenses are really, 700, and, maybe you can underwrite to, 600 or 500, and you kind of take a blend between the two. But generally, we're going to have to lean on whatever the appraiser determines as market, which is why we try to spend a lot of time on the front end, really dialing in on the expenses. We see this all the time with, other lenders, and people will just throw out a debt quote and say, oh, we're able to get to 80% leverage, but you don't actually go through the line by line of how they're actually solving to that leverage or that loan amount. And so it's always important to make sure you spend time on the front end understanding how the lenders are underwriting to get to the loan amount, and making sure that that ultimately is supportable once you get to loan commitment and to rate lock into closing, that the loan amount is actually doable and it has a high sense of execution.
Excellent. Thank you so much. On the other page, you had the different options, the different loan amount options at the different LTVs. And then you show the max LTV of 80%, as long as you can, meet your minimum DCSR or DSCR, excuse me. What kind of rate difference may you see from, the 75% LTV if you move closer towards that 80% LTV?
The rate will be the same. It's in the kind of the same tier bucket. Where you start to see a delta in rates is once you hit, 65% LTV, you probably see a, 20 to 25 basis point drop just because it's lower leverage. But once you go above 65%, it's in the same bucket. So you really don't see a lot of, increased rate because of the higher leverage between 75 and 80.
Excellent. Even if you were to drop down to 70% LTV, that probably still similar rate?
Yeah, I would say in some instances, maybe you could come in 5 basis points lower, 5 to 10 at the most, but where you really see the significant drop is once you hit 65%.
Okay.
Obviously, the loan amount will be affected by that as well, right?
Right.
And that's why we're trying to max those loan dollars so that you don't have to capital raise as much.
Right. Excellent. That's all I have for now. So thank you so much for setting this up, Julie. Thank you so much for your
Absolutely.
time, Fritz, Frank, or Troy. Do you guys have any questions?
No, I don't have anything else. Thanks a lot. Appreciate the walkthrough there. Makes a lot of sense to me.
Yeah, I just
Great.
had one question, and it's pertaining to like a refi scenario. So if you have the property, it's running very well, and you're at a, let's just say a 70 or a 65 loan amount. If you refi and take it to an 80, can you or 75, is the expectation that your rate is actually going to increase that much, or do you actually create, what would you say, like kind of like an approval of operations or something like that, where you can maintain your rate at a higher borrow? Does that make sense? So if you say you took your initial loan out at 65%, and then 3 years later, 4 years later, you finish everything, you refi, but you want to take it now and maximize your cash, so you take it to a 75, 80%. Do you have any sort of like track record with them at this point in time, with that being at the same property, where they're going to look at that and say, okay, we can do that, even though they're absorbing a little bit more risk, but they've seen what it is. They have like, or do you expect your
Sure,
rate?
I think I understand what you're asking, but so each of these loans are individual mortgage-backed securities, and so if you had the original loan, and even if you did a bank loan, say you did a 65 or 70% loan at a 3% interest rate at the time, at time of refinance, if you wanted to borrow up to 70% or 75%, you would pay off the existing note and you would reset the rate at current rates at that time. So you wouldn't blend it or keep the other one outstanding. You would completely pay it off and then just reset at market interest rates. You wouldn't kind of blend the rate. I think that's what you're asking. Am I answering your question?
Yeah. Well, I understand what you're saying, that you're going to reset the rate, but my question would be, is that reset now going to work in your favor as far as you have now a record of operating it? Or are it's just straight across the board, they treat you just like, okay, this is brand new again, even though you're the same operator?
Yeah, no, you look at it differently. When you look at a refinance versus an acquisition, you're going to lean more heavily on, in-place operations. But again, but you still have to get an appraisal to say, hey, these are still market. But like I said, you're going to lean heavily on existing expenses. So, for example, when I was talking about, like, if payroll was $1,400 a unit, that's how you're operating it. and it would be hard for us to justify on a refinance that we can underwrite 1,000 because you've been operating the property for 3 years at 1,400 a unit. So that's where you don't really have as much flexibility and expenses that you would have on an acquisition.
Right. Okay.
All right. Well, that was, I'm assuming that was very helpful for you guys. And this is what Old Capital does. We provide this little bit of different value than what other mortgage brokers are doing. So we really appreciate your support, and we'll looking at your future deals together.
Thank
All
you
right.
so much.
Thanks,
Again,
Julie.
Really,
You guys have a
really
great
appreciate
Thank you guys
your
so
time.
much.
Thanks.
You're welcome. Thank you, Fritz. Really appreciate your time.
Yes, you bet.
Okay. Bye-bye.